If one stock makes up too much of your net worth, you're betting your financial future on a single company. Even the strongest businesses can be blindsided. A scandal, a leadership shakeup, a sudden industry shift. In this video, I'll show you a step-by-step process to reduce that concentrated stock position in a tax-efficient way so that you can potentially protect your wealth without giving more of it to the IRS than necessary. For those of you that don't know me, my name is Zach Morris, and I'm the founder of Paces Ferry Wealth Advisors, and I've been helping people retire for 14 years. Let's go ahead and jump into this analysis. So what we have here is a list of different lots. So every time you buy a stock, it creates a tax lot. And these are all bought at different time periods. So for the sake of today's presentation, I've hidden the different dates that they were bought, but it could be any date in history, and each one is going to have a different purchase date and a different purchase price. So here's your cost per share for each purchase date or each tax lot. And then here's the quantity that was purchased on that date. So a couple things going on here. Here we have the market value, which is just going to be the price today times the quantity. And then we have the cost basis. So the cost basis is going to be what you paid on that day. So in this case, $150 per share for 2,000 shares. And that's the cost basis. And then your unrealized gain loss is going to be your market value minus your cost basis. So in this case, it's a loss. Down here, we're going to have gains. And this is sorted by the percentage gain loss. So that's important for a reason I'll explain in a second. So the first step of the process is to use your losses to offset gains. So we're going to take a look at this analysis and say, how much losses can we take? And then what does that mean from a gains perspective? So how much gains can we take without paying any additional taxes? So here you can see, and the reason why we have it sorted by percentage gain is to use this lot as an example. Here we have a large dollar gain, right? But from a percentage standpoint, it's only a 21% gain. So what we want to do is figure out how we can get the most bang for our buck, right? How much market value can we get for the purpose of diversification, right? We want to diversify away from this concentrated stock position. So how much market value can we get for the amount of gain that we're taking? In this case, we're able to get a lot of market value, even though we're taking a $49,000 gain. So what we're going to do is we're going to see how much losses we have. So here we have a total of $190,000 in losses. And if we were to sell all of that, we're going to raise $527,000 worth of market value. So that's a lot of money that we're going to be able to use to diversify away from this concentrated stock position. Now, the total value of this concentrated stock position is just under $2.9 million. So we're going to take a number of different steps to try to mitigate that and also not pay a whole lot of additional taxes in the meantime. So $190,000 in losses, and how much in gains can we take in order to not pay any additional taxes? So the answer is about $190,000. So we can continue going on all the way up until this point, which is about $192,000. So we'll have an additional $2,000 gain. But if we look at everything that we sold up to that point, so we're going to be able to raise $1.4 million in cash without paying any additional taxes in order to diversify away from this concentrated stock position. So here's our 1.4 million, and here's going to be our gain loss, which is just about 2,000. So we're netting these losses against our gains and vice versa. So now that we've sold those positions, let's go ahead and delete these cells so we can see what we're working with. Now, we've got $1.5 million left of a concentrated stock position, but we're not out of steps yet. So now that we have $1.5 million worth of concentrated stock left, which is down from the 2.9 that we had before, what are we going to do in order to further diversify our portfolio, but still mitigate the taxes going forward? So in this client's example, they are very charitable. So they give about $20,000 a year. So what we recommended was that they give 10 years worth of gifts in 1 year. Now, when you give appreciated stock, which is a great strategy, you can only give up to 30% of your adjusted gross income in any 1 year. So what we've done here is we've figured out how we can give away the most amount of money so that we can get a deduction while offsetting some of our gains. So here we're going to give this lot. So we're going to gift this lot. And the reason why we're focusing on this lot is because it has the highest percentage gain. So when you give money to charity, when you give appreciated stock to charity, it's important to pick the highest gain lot, because what you're doing is you're avoiding that gain. So if you paid $1 for a stock and it's now worth $10, and you gift that stock to charity, well, you get a deduction for that $10 and you never have to realize that gain. So in this example, there's a 6,800% gain here. They paid $2 for the stock. Now it's worth $103, and they have an unrealized gain of $210,000 with a market value of $212,000. So when they gift that to charity, they can deduct all of it up to 30% of their adjusted gross income. Now, anything that they don't use in that year can be carried forward for 5 years. So here's where their situation stands today. Assuming that they don't give any money to charity and they don't make any large sales, resulting in large capital gains. So here they have no capital gains. They have $375,000 worth of income because that's what they get through their 2 jobs. And then they have deductions of $29,000. So that's a standard deduction in 2025. And then they have taxable income after deductions of $345,000. And their total tax that they're going to pay is $68,577. So that's the total tax that they're going to pay if they do nothing. So now let's see what happens if they're able to offset some of their capital gains that they might get through selling this concentrated stock position with a charitable gift. Remember, they give $20,000 a year in charitable giving. So in this year, we're recommending that they give a larger gift, 10 years worth of gifts that they can use to offset the tax liability that they might get from selling their concentrated stock position. So what we're going to do is we're going to add up the total gains that they're going to get from selling these lots. So that's $230,000. So if they were to just realize that $230,000 in gains, in long-term capital gains, let's see what that would do to their overall tax situation. So here you could see if they were to take that gain, if they were to take that $230,000 gain without doing any charitable giving, their total tax liability would have gone from $68,000 to about $112,000. So over $40,000 worth of additional taxes. And here you could see they're still taking the standard deduction, and their total income, because of that long-term capital gain, is going to increase to $605,000. Now, in order to offset that new long-term capital gain of $230,000, we're going to gift $180,000 worth of stock. So it's going to be about 1,754 shares, and we're going to give it out of this lot because it has the highest percentage gain. Now, watch what happens when we apply that charitable gift to the same tax situation. So we take the $230,000 gain with $180,000 charitable gift. And now their total tax is $73,000. So remember, before we did this strategy, their total tax was $68,000. So a concentrated stock position can be an incredible wealth builder, but it can also be a wealth destroyer if the wrong thing happens at the wrong time. The goal isn't to abandon a winning investment. It's to protect the lifestyle and financial goals you've worked so hard to achieve. The strategies we've covered today can help you reduce risk and diversify in a way that's thoughtful and tax efficient. But every situation is different, and the right timing, the right tools, and even the right pace of diversification depend on your specific portfolio and goals. If you're sitting on a concentrated position and wondering how to unwind it without handing over too much to the IRS, this is exactly what kind of planning we help people do. Reach out and let us put a plan together for you that protects what you've built and gives you confidence for the future. Again, my name is Zach Morris, and I'm the founder of Paces Ferry Wealth Advisors. If you've enjoyed this video today, please go ahead and hit the subscribe button and be on the lookout for more videos from this channel. Thank you.